So agenda for today is, first we'll be speaking about various stock market economic indicators. So these are genuine, these are real indicators which economists are using to assess the state of the economy. Okay, then we'll be speaking about so-called surprising stock market indicators, and these are more alternative indicators. They're not based on any theory, they're not based on any analytical work, and they're mostly derived from gut instincts or maybe just like overall observations. So when I'll be speaking about all of them, please take them with a little bit of pinch of salt, because you might find some of them very humorous, very unusual. So just be considerate, okay? And when I'll be speaking all of them, just make sure that don't take them for granted. So then we'll speak about one of these indicators in more details, and this one is a Skyscraper Indicator. We'll speak about what is rationale behind this indicator. We'll speak about the dynamics of it, what's the main reason behind this indicator, and then we'll see whether it is applicable for the UK property market. Okay, and then we'll have a question and answer session. So stock market indicators. Since the introduction of the stock markets, analysts, economists, investors try to predict the future trajectory of the stock markets. Okay, so they were developing different tools, analytical methods to assess the current state of the economy, state market, and then try to predict what's going to happen in the future. As you may see, some of them were developed based on a technical analysis, robust research, and some of them were based on the general observations. And as I said, from the gut, they came up as a result of a gut instincts. Okay, so speaking about real indicators, like a general, which are used by economists, one of them is Consumer Confidence Index, and this one is used by Americans in particular, same in UK, in France and Germany. And what it is saying is that it assesses the current state of consumer and how confident consumer is. Okay, so as you may know, in many countries such as United States, consumer confidence, consumer spends about 70% of GDP. In the UK, it comprises about 75% of GDP. So when a consumer feels good, when it feels confident about future, about the economy, it spends more. Spending generates additional income, and it rolls the economy out. And as a result, it lifts GDP, and then it has a knock-on effect on the stock market. So then the stock market is going down. When on opposite, when consumer doesn't feel confident, consumer doesn't spend money, GDP is going down, and it has a result. As a result, affects the stock market. Okay, so what it's telling now. In the United States, in April, it fell from 72 points to 72 points. So we see, although American economy is picking up, we had a recent growth by, I think it's by a couple of percent, consumer doesn't feel so confident. So the takeaway of this one, although economy is improving in states and probably improving elsewhere, we're now not out of the woods yet. So it's kind of, there is still growth opportunities. Another one, which is widely used across the countries, is a job claims indicator. In the United States, it's called, in the United Kingdom, it's a job seeker allowance claims. And why it matters, it is conversely related to the general economy and the stock market. So the bigger job claim numbers are, the more people are out of the job. So the more people out of the job, the less people are in the economy. The less money is in the economy. The less money is in the economy, the less it generates economic activity, and as a result affects the stock market. When this indicator goes down, executives feel more confident. They hire more people. More people feel then confident, they have a job, they have an income stream, they spend more, and then it again affects the general economy and the stock market. So what we're seeing now in the United States, it has dropped to 334,000 in April 2013. It is a good number in general. If you look at across the board, it's much better than it was last year or the previous month. However, it's much higher than which was in 2006, which was about 300,000. So it's about 10% higher than the normal rate when times were good. Okay, so what the takeaway of this one is that we see that the economy is improving, but we should use a little bit more, maybe stimulus or other measures to improve the current state of economy and jobless market, job market. Okay. Another one, which is will be the last one of the real indicators, is a S&P 500 stock market moving average. And what in this indicator is a moving average of a S&P 500 over a period of time. Usually Americans, they analyze it over a 200-day period. 200 days is about 10 months. So they have a clear divide between bull market and bear market. When S&P 500 is higher than its LTA or long-term average, then it indicates that it's a bull market. It's time to invest. It's a good opportunity to pile in the stock market, and as a result, it kind of acts as a catalyst for additional investment. When it's lower than its LTA, then it's a bear market. So people then analysts suggest that it's time to sell shares, and it's probably it's a good way of going out of the market and invest somewhere else. What we're seeing now in April 2013, S&P traded 12% year to date and 13+% year on year. So the takeaway is that we see that American economy and stock market is improving, considering from what it was at the beginning of the year and from a previous year. Okay, so now we're going to speak about a class of alternative stock market indicators, and I call them surprising stock market indicators. When I'll be speaking them, don't take them too serious, okay? Take them with a little bit pinch of salt, and I hope you'll find some of them very interesting and maybe applicable to the UK market, okay? So one of these is a Pallet cardboard indicator. It's probably, I forgot to mention, we'll be speaking from the most serious to the least serious, okay? So this one is the most serious of all the surprising stock market indicators, okay? So the idea of the Pallet cardboard indicator is that the higher the demand for storage boxes and shipping pallets, the higher the demand for products being shipped. And you probably see, whenever you buy something online or in store, it's very likely that an item you bought was in one form or another in a cupboard or in a box, yes? So the shift of boxes and the number boxes are produced can tell you whether the economy is doing well or not. Okay, so you know that you have a China. It produces a lot. Everything moves to Europe, America, and somewhere else. So this move of a pallets and card box and the level of trade can show you whether the state of economy. Okay. Yeah, and if you look now at the Smurfit Kappa Group PLC, which is the largest European cardboard producer, it is trading at 23% year to date, so basically from January the 2nd, and 78% year on year. So looking at this one, you can tell that yes, cardboard box sales are going up. We see that shares of SKG Group are going up. So it's very likely that the economy is doing well. And interestingly, a gentleman called Alan Greenspan, you probably know, he was a former chief executive of Federal Bank in America. He was a proponent of cardboard indicator. He was looking at the sales of cardboard and then assessing the state of the American economy. Okay. January effect. This one is one of my favorite. Is one student from Chicago Business School, he was studying probably something like this, like finance. So he was studying finance, and what he noticed that every January stock market is going up, and then there came this saying, as goes January, so goes the year, and this one goes to the psychology of people that you expect that next year is going to be a good year. You make your New Year's resolution, you say, okay, so next year is going to be much better than last year, and then everyone rush into the stock market and buy shares. And as a result, it lifts the market. And what we see now, FTSE 100, which is the index of the highest capitalized companies in the United Kingdom, had a stronger start in 24 years. So based on this indicator, we can say, yes, 2013 is going to be a good year. Okay? This one is a very unusual indicator, and it's a HBS indicator, and the idea is that it demonstrates long-term trends based on the attractiveness of Wall Street jobs. And idea is the more business graduates are entering financial service institutions, it's very likely that economy is somewhere at the top and about to burst. If he estimated that the gentleman who came up with this idea, he was a business HBS graduate himself. And what he noticed that if 30% of business HBS graduates are entering financial jobs such as trading, exchange, selling exchange, and so on, it's very likely that the economy is about to burst. If less than 10% of going out of the HBS are entering financial companies such as Goldman Sachs, JP Morgan, and others, it's very likely that the economy is doing okay. So what we're seeing now, and the idea of this indicator is that attractiveness of financial job attract the smartest people in America, and then it kind of rolls on, and then you see what has happened in 2008, 2009. Everything is gonna bust. So in 2012, 2013, the HBS reported that less and less Harvard graduates are entering financial jobs. This one is a kind of a little bit different indicator, and it has been created by The Economist, the financial journal based in London. And what it suggests what they are saying is that it's the world's most accurate financial indicator based on a fast food item. And the idea of this indicator is that the theory, it is based on the theory of purchasing power parity, which is the notion that $1 should buy the same amount of product every country. And why they're looking at the Big Mac is we're looking particularly in McDonald's sales. You have McDonald's, which operates in 120 countries. So you have from America to Japan. It sells hamburgers almost everywhere in the world. And it has 34 different currencies. So what this indicator does, it compares different currencies across the board, and technically, if everything is equal, currencies are in equilibrium, you would buy the same amount in one country and the same amount in another country. So let's say in America, if it's $2, you would probably should pay the same in Lithuania if currencies are equilibrium. But because it's not in equilibrium and it's different currency, the difference between Big Mac in America and in Lithuania can indicate whether currency is undervalued or overvalued. Okay, and this also indicator is used to assess whether currencies are undervalued currency undervalued by the government. So basically, what we're seeing now in financial press, they call it currency wars, and everyone is blaming Chinese or Brazilians that they're lowering their currency rate in purpose to improve their export. Okay, so this one is one of the most unusual indicators. Okay, this one is a conversely has a negative correlation with the general economy, that when the economy is not doing well, people don't feel well, people get headaches, they buy aspirin. When the economy is doing well, you feel okay and you don't need aspirin. And when you see what has happened with wheat sales, in 2001, they reported that Advil, which is one of the most popular painkillers, the sales were up 2%. In 2013, Bayer, which produces aspirin, this one, reported that sales were flat in Q1. So you could expect that because aspirin sales are flat, people don't need people are feeling well, and maybe economy is not doing bad. This one is one of the newest indicators, and it was developed by the Polytechnic Institute of New York University. And one professor, he looked at the economy at the stock market volatility from 1957 to 2007 and compared again beat variance in songs. So he looked at the Billboard, which is in America very popular kind of its chart. I think in Lithuania we have MVN's chart or Radio Center's chart. So Billboard is an American one, and he looked at the volatility in songs and volatility in the stock market. And what he identified that songs with high beat variance preferred in times where market volatility is low. So when the economy is doing well, market is not volatile, let's say it's growing steadily, you feel well, you feel okay, and you try to listen music with a high beat. You're enjoying yourself. However, imagine when the economy is not doing well, let's say 2008, 2009, it's very likely that you'll listen something more smooth, something calm, don't you? Okay, so this came up as an idea. He kind of, related this psychological idea of listening to the music to the stock market volatility, and came up with this Billboard indicator. And interestingly, this one is probably the most scientifically approached indicator of all the indicators which are available, because he kind of used the statistical data to analyze all the data he has. And in 2013, I've just looked recently, yesterday, at the Billboard, and I can tell you that consistent beat songs dominate the chart. So it's very likely that Americans are not very much enjoying themselves, and they're listening pop music rather than listening AC/DC or rock or something like that. This one is one of my favorites. As a big fan of sport, I think this is a great indicator. And the idea is this one is a one-off indicator. And what it suggests is if a team from AFC, which is American Football Championships, wins Super Bowl, it's very likely that stock market will go down. If a NFC team, which is National Football Championship, team wins the Super Bowl indicator, then it's very likely that stock market will go up. And unfortunately for 2013, this year's AFC Baltimore Ravens defeated NFC San Francisco 49ers. And interestingly, I was speaking to my colleague Owen, he's American himself, and I said, Owen, what do you think about this? And he said, it's true, in America they believe that this indicator does work. And we've looked at the data, and if you would follow NFC Super Bowl indicator, in 80% you would be right, which is not bad, considering that, in most of the cases, how much you have, 50-50, 60-40, 80% accuracy, not bad for very unusual indicator. Okay. Boss Knows Snow indicator. This is another good one. It's again one-off indicator which suggests that White Christmas in Boston means a rise for the stock market the following year. And in 2012, the state of New England experienced a record number of snow. So what it suggests that because the Americans had a White Christmas, in Massachusetts experienced White Christmas, it's very likely that the economy will be doing well next year, and the stock market will go up. Okay. This one is one of the hottest. It is based on the nationality of a Sports Illustrated swim cover model. And when the cover model is from the United States, the S&P is likely to outperform the general market. If, however, non-American is on the cover, it's very likely that S&P underperformed the general market. It wasn't always the case, because there were instances when Czech model was on the cover and the S&P outperformed the market. And the same again was when American was on the cover model, stock market went down. But in general, the rule is that American on a Sports Illustrated swimsuit cover is good for the economy. And in 2013, we see Kate Upton. She's American, so it's very likely that the economy will do well next year. Another one, which is very unusual, is a lipstick indicator or lipstick effect. And what it suggests is that lipstick sales increase during a recession or times of economic uncertainty. This one comes back again to psychology. Imagine yourself, economy is not doing well. You're not secure about your job. You're not secure about your mortgage, car, everything else. You have to pay tuition fees. And as a compensational or emotional aspect, you try to use a lot more makeup. You want to kind of compensate that diminishing feelings about the economy, that everything is not doing well. So you try kind of to look a little bit better, yes? And this lipstick indicator was suggested by a gentleman called Lauder. He's the chairman of Estée Lauder. And what he noticed that after attack of September 11, when a stock market went absolutely down, sales of his lipsticks, of Estée Lauder lipstick, were absolutely enormous. And then he looked after the following year, next year, and he clearly saw that, when the economy is not doing well, lipstick sales are going up. And in 2013, Q1, Estée Lauder revenue grew 10% year on year, with other cosmetic sales up across the board. So what it might suggest that maybe economy is not doing well. But it's not bad, you know, we have a pretty woman around, so it's fine. Okay, and last but not least is a helmet skirt indicator. And then again, the idea is short skirts market when women are wearing shorts, not women are wearing shorts, but when short skirts dominate fashion shows such as London Fashion Week or New York Fashion Week, economy is on the rise. When long skirts dominate the fashion week, whether it's in London, Paris or New York, markets are heading down. And then again, imagine yourself. You feel well about the economy, you feel good, you're secure about your job, life is great, and it's very likely that you're well a little bit shortish. Yes, but then when the economy is not doing well, it's kind of, you know, oh, wow, I'm not sure about my job, what's going to happen tomorrow, I won't have enough money to pay for my mortgage. It's very likely that your skirts will go down. And why fashion weeks such as New York, London or Paris? It's because it attracts fashion makers or designers from all across the world. And you have people from Russia, America, China, South America, everyone coming into one place, and you can see consistency across the board, and you can see how consistent they are. And it's very and when global economy is not doing well, it makes everyone feel insecure, and as a result, your skirts are going down. If, however, economy is doing well, it's global economy is growing, it's very likely that skirts is going up. So it's very unusual. And in 2013 at London Fashion Week, there was a significant drop in hemline left. So basically, long skirts dominated the London Fashion Week a few months ago, which indicates that economy is not doing well. Okay, so in 2013, what we have? Harvard grads are not entering financial jobs. Excellent. Aspirin sales are flat. Good. Unfortunately, AFC team won the Super Bowl, and people are listening music with consistent beat, so they are not secure about the economy and job market and so on. Sports Illustrated cover, American is on the cover of Sports Illustrated. Brilliant. SKG Group posted record sales. Very good. Unfortunately, cosmetic sales are going up, and skirts are going long. So I'm gonna leave it to you to decide whether economy is doing well or not. Because now we have 1, 2, 3, 4 positive, and 1, 2, 3, 4 negative. Okay? Okay, good. So now we're going to speak about one of these in more detail. We'll have a look at the Skyscraper Indicator, which is more kind of to my field. So we're going to analyze this indicator and how it did it perform in how it was applied to the UK market. Okay, so let me read this one. I really like this quote. It comes from Mark Taunton, the professor from America. And what he's saying is that the skyscraper is the great architectural contribution of modern capitalistic society, and is even one of the yardstick for 20th century superheroes. But no one have ever really connected it with the quintessential feature of modern capitalistic history, the business cycle. Okay, so what he is suggesting, Taunton, is that Skyscraper Indicator does have a good records in predicting important downturns in the economy. And a gentleman called Martin Lawrence, who works for Barclays Capital in Hong Kong, I was speaking to him when I was doing my research, suggests that there are economic linkages between construction booms and financial bust and an attempt to build the tallest building. And I'm going to explain you why it is. So when you have easy credit times, during the easy credit times, low interest rates, let's say what we had in 2006, 7 and 8, it makes capital cheaper. Okay, you can borrow cheaply than previously, and as a result you build more. You build somewhere, let's say in central business district, which makes a land scarce because no one can, there is not definite capacity in that. So because you build more, you have cheap capital, your land becomes scarce and it becomes expensive. Another thing is that during the same time, when easy credit and during the easy credit time and low interest rate times, firms get larger. Firms can borrow money from financial institutions, expand, hire more people, and then it again comes. You can build more. However, your land becomes very expensive. So imagine the situation: you're a business person, you hire more people. Okay, you have a lot of cheap capital. You can build as much as you want and as much as you can, but your land is scarce. You have a little piece of land. What do? You need all those people to accommodate somewhere. You have cheap money. You can build. So what do? You go up. Okay. So because you can't expand and you need to pile people somewhere, up. Okay, so the idea is that generally the skyscraper project is announced and construction is began during the late phase of the boom of the business cycle. Business cycle go up, credit is cheap, unemployment is low, and you build. When the economy is growing and unemployment, so of the phase of the business cycle, when the economy is growing and unemployment is low. This is then followed by a sharp downturn in financial markets and economic recession. And then skyscraper is completed during the early phase of economic correction. Because to build a skyscraper, it takes time. So when the business cycle goes up, unemployment is low, everyone is employment, you need to find people, you start building. But by the time you finish your project, economy is in correction, okay? So now let's have a look how it looks like. Panic 1907 coincided with a construction of two tallest buildings. One is Singer in New York and Metropolitan Life. Then we had Great Depression in 1929, and you can see that the world famous buildings, Empire State and Chrysler buildings in New York. So you can see, okay. Then 1970s stagflation coincided with the WTC Center, with the World Trade Center, which doesn't exist anymore. We have now one Trade Center, I think. What's the name of it? Because, after attack 9/11, this used to exist. And then again in Chicago we have Sills, or formerly known as a Sears Tower. In late 1990s, Asian crisis. We had the tallest building in the world built in Kuala Lumpur, Malaysia, Petronas Tower. And now everyone is known, world's famous tallest building in the world, Burj Khalifa, based in Dubai, coincided with a credit crunch and global financial crisis. Okay. So now this is how it looks like. So you can clearly see that buildings are going up, and it coincides with the economic corrections. Okay, so we have World Trade Center with Sears Tower, Petronas Tower during the Asian economic expansion and global financial crisis, and tallest building and the current tallest building in the world. So the idea was before, the previously was thought that Skyscraper Index was unable to predict the UK crisis because this index was based on US market data and general world economy. However, Skelton and other researchers argue that Skyscraper Index is applicable in the UK. So, so now you have a situation. People suggest that no, you can't do this, it's not applicable in the UK. But some say that yes, it can be. So what I did, I plotted economic corrections which happen in the UK against the tallest buildings when they were completed. And what we see is 70s crisis, as previously, it coincided with a Guy's Tower, of a completion of Guy's Tower in 1971. And interestingly enough, Guy's Tower is a hospital. It's one of the tallest buildings. It was the tallest building in UK, and it is hospital. Okay. Then the Thatcher crisis, when Margaret Thatcher came into power, it transformed British economy from manufacturing to service-based. And then you had correction in the market, which coincided with completion of Tower 42. Okay. Then you had 80s crisis and completion of One Canada Square. You know this building. It's a kind of a square building with triangle on top. You always see it in London. Following 1990s crisis, we had the completion of Citigroup Tower and HSBC headquarters in London. And now again, you might know if you've been in London yourself. You saw the Shard, which is the tallest building in Europe, in the UK, and in Europe now. And it was completed in 2000. It's still kind of under construction, but it was announced to be built in 2009, which coincided with a credit crunch and global financial crisis. Okay, and this is how it looks. So now you have UK GDP growth, and then you see Guy's Tower. Okay, and you see GDP is going down. Then you have Tower 42. Going down, okay? In analyzing Skyscraper Index, you should always bear in mind there is a time lag between completion project, because it's not easy to build this tower, let's say in 1 year or 2 years, so it usually takes like 3 or 4 years, okay? So now you have One Canada Square, again, correction, City and HSBC, 2000, 2002, it's probably coincided with a dot-com bubble. And what we see now is the Shard, the tallest building in UK and the tallest in building, which coincided with global financial crisis and economic correction in Britain as a result. Okay. So another interesting observation which I noticed was that all of these buildings were built in London. And I thought, okay, so why London? There is no particular reason about it, but apparently there is. First of all, London is a headquarter of majority of organizations. And interestingly enough, neither New York, nor Singapore, nor Hong Kong has the amount of headquarters that London has. London is truly a global city and financial center, okay? Another thing is that most of the government and administration institutions are located here. So when you have a lot of public sector, when you have a big public sector employment, it's very likely you need to put them somewhere. So, and this is happening in London. Okay, and the last one is a growing ratio of foreign investment into London office market. Previously it was German funds, Japanese funds. Now you have Arabs highly investing in London, and then you have Asians such as Malaysia, China, and everyone else coming from Asia and invest in London. And as a result, all these kind of segments, big public sector, foreign investments, and London being a financial center makes it a very special place. Okay, so what can be next? What can we tell about this one? Knowing this relationship between the attempt to build the tallest building and economic correction, we can expect that the next attempt to build the tallest building in Britain can signal that the economy is overheating and it's about to burst. Okay. However, this indicator shouldn't be used, should not be employed as a milestone for fiscal and monetary policy. So when someone will try to build the tallest building in UK or in the world, central bankers shouldn't say, "Oh my goodness, we should raise interest rates or do like maybe less quantitative easing or anything else just to stop them building building a tallest building." And another one is that height restrictions for skyscrapers should not use as a tool to prevent property economic crisis. So when it's very easy, let's say G20 will come up and one day, okay, say we're not allowed to build the tallest building in the world. If they will do so, we will still have economic crisis. So this one shouldn't work as a catalyst to kind of to make any planning decisions. Okay, so I thought I'm gonna add this one. So knowing this all relationship and knowing these different indicators, we should always bear in mind that there are two kind of forecasts, lucky and wrong.